Hey everyone, I want to talk about something that's happening right now. If you've been investing in real estate over the past few years, there's a good chance you've received an email lately that you didn't love. Maybe distributions were paused. Maybe there was a capital call. Maybe the refinance didn't go through. Maybe the tone of the update shifted from confident more recently to now cautious. Or maybe you're just watching from the headlines and seeing words like distress, foreclosure, loan maturity, for sale, and you're thinking, wait, I thought real estate was doing really well. I thought they were good deals. These properties, they look solid. Maybe the market was strong at one point. The operators that you invested with were experienced. So what happened? Today, I want to break down really simply why good real estate deals fail, what this current cycle is exposing, and how to think differently so you can invest smarter in the next one. No jargon, no spreadsheets, just a mental framework that you can actually use. Enjoy.
Welcome to the Passive Income MD podcast, where we talk about creating your ideal life through multiple streams of income. If you enjoy hearing about this stuff, make sure to hit subscribe. Now let's get on with the show.
Welcome back. I want to start with a pattern that, again, I've been noticing in conversations lately. I've been hearing from a lot of physicians who are either invested in real estate already or they're seriously looking at deals right now. And what's interesting is this. The emotion I'm hearing, it's not panic. I think it's more like confusion. I think people are saying, like, I don't get it. The deal seems so good. The property seems fine. Occupancy is good. They're making enough income. The market doesn't seem terrible. So why does this deal feel off? Why is it not doing so great? Again, maybe distributions have slowed. Maybe they've stopped altogether. Maybe the numbers are saying technically kind of work, but then there's this underlying anxiety around the deal that didn't exist a few years ago. And if that's you, I want to clearly say this up front. You're not the only one. Like, you're not missing something obvious. That feeling that you're having, it's not because you're bad at this. You're just running into something most people were never taught to look at. In a lot of cases right now, again, the issue isn't the property, it's the debt that's underneath it. And I know this well because this is in some of the deals that I'm dealing with as an investor or running some deals. And so you're probably seeing this. And if your first reaction to all this is, that's why I invest passively, so I don't have to understand a lot of the debt stuff. Well, that's exactly why this conversation matters. I thought it was important to talk about it today. Again, you don't need to be a real estate expert to understand what's happening. You just need to understand how the loan behaves overall. So I'm going to try to strip this down. Like, when you buy real estate, again, most of the time, you know this, you're not paying all cash. You're borrowing some amount of it, some money from the bank, and that's considered the debt. And every real estate deal has one basic job: make enough money to pay operating expenses, pay the bank, and then ideally have margin or profit left over. And that's it. Now, if we can't do that, then it's not necessarily the building itself is broken. It just means the model is at that time. It means the math is broken too. For a long time, the math felt pretty forgiving. Especially after 2008 and everything happened, their interest rates mostly went in one direction. They went down. And so cheap money became normal. It's something we were all used to. And kudos to you if you refied your own home at a really, really low interest rate. And without realizing it, I think a whole generation of investors learned this lesson, that debt is your friend, that you can just refinance later. Rates will probably be lower. It'll always continue to go down and values will probably be higher. And to be fair, that playbook worked for a long time. Again, that wasn't people being stupid. It wasn't being reckless. In fact, that's what it was like. That was adaptation at the finest. And that's exactly what was happening at the time. But here's what changed. We all know that interest rates in 2022 went up at the fastest rates that we've seen in our lifetimes. And they didn't just, again, creep up slowly. They went really, really quickly. Loan payments doubled, sometimes tripled. Again, not because the property itself underlying the deal, it didn't get worse. It's not because the operator forgot how to operate, but because the cost of the debt changed. And this is where I want to slow down a little bit because I think this distinction matters. This cycle, the one we're in right now in this real estate cycle, it didn't just expose bad deals, it exposed fragile ones. And there's a huge difference between a bad deal and a fragile deal. Like, a fragile deal only works if certain conditions stay true, like there's low rates, easy refinancing, consistent appreciation of values. And when those assumptions break, and when they do break, sometimes they all happen at the same time, unfortunately, The deal doesn't bend, it cracks. And I think many of you are experiencing that right now. I've experienced it myself.
Hey everyone, I have a question for you. What if there was a way to make your money work for you instead of the other way around? Let me ask you, are you looking for a way to create passive income and secure your financial future? Or maybe you've stayed away from real estate because you don't have time to be a landlord. Then I want to introduce you to Passive Real Estate Academy. It's the revolutionary platform that we created that teaches you how to invest in real estate passively with little or no effort on your part. In just 4 weeks, our comprehensive course will teach you everything you need to know about passive real estate investing and help build that confidence in you so that you know that you're making a great investment choice. We created this course for busy people like you, and we're going to guide you from every step of the way, from understanding even the most basic information to understanding the jargon and understanding underwriting so you can make sure that you're making a great investment, that you're maximizing your returns and minimizing your mistakes. And the best part, you can do this all from the comfort of your own home with absolutely no prior experience required. So it's time to prepare yourself and learn so that you can be ready for these deals that you see, because the time is coming. So don't let the demands of your job or the current economic climate dictate your financial future. So join Passive Real Estate Academy and build that confidence to know that you're making a great investment when it comes to syndications and funds. So visit our website at passiverealestateacademy.com to learn more and take your next step to financial freedom. Now back to the show.
Now, one of the biggest mismatches in real estate is this. Real estate is considered a long-term asset, and ultimately that's how we all need to think about it. But a lot of the loans, they're short-term instruments, especially in the commercial space. 3 years, 5 years, sometimes interest only, sometimes floating rates. And again, that structure works beautifully when refinancing is easy, but when a loan comes due, the bank doesn't care how nice the property is. They don't care how hard the operators and sponsors have worked to put it in great condition and create great living conditions for the tenants. They don't care that the business plan just needs a little bit more time. They just want their money. They want their money back when they want it, or they want new terms, and that's it. That's why I keep saying a lot of real estate deals, they don't fail because they're bad. They fail because they run out of time. And this matters whether you're active, meaning you own it yourself, or you're passive. Again, I hear passive investors say this all the time. I trust a sponsor, they'll take care of the rest. And I get it. Trust matters. In fact, that's what passive investing is about. Finding the right people to invest in, leverage their capabilities while you do the thing that you do best, which for most of us is practice medicine, spend time with our families, and let other people take care of the other part. And you trust in their expertise. And that makes sense. And it really does that most of the time. But trust itself doesn't mean that you're not responsible for some understanding. And that's why we're talking about it here on this podcast. I mean, the bank is a silent partner in every real estate deal. And often, to be honest with you, it's the most powerful partner in the room. Like if you don't understand how that loan behaves when rates change, when values change, or when time runs out, you don't fully understand the risk you're taking. I think that's something we've learned in this cycle more than ever before. For most of our investing career or timeline, have invested only in a good market. And so we're learning a lot in this cycle right now. And so I guess the question becomes, how do we learn from this? How do we do better in the next cycle? Because the truth is, all of real estate, all of life, like seasons, everything moves in cycles. So you have to understand where we're at in the cycle today, and then how to take advantage of the next part of the cycle, to predict those patterns and to be able to use those patterns to our advantage. The question is, again, how do we do better? Not perfect, but just better. Because the goal in real estate, again, it's not to predict the next cycle perfectly, exactly. Don't time it perfectly. I think not everyone realizes you cannot do that. It's to be part of deals, to build deals that don't require perfect conditions to survive. And I think that's how we're all learning right now. And I've had to learn that the hard way myself. And here's how my mindset has shifted. First, I care about the timeline more than I used to. I mean, I always respected that, but there are many different factors that go into how long a deal is allowed to go for, whether it's the debt, whether there's another lender in the situation called a preferred equity lender. I look at all these things and I think, how long can this deal survive if things don't go as planned? Does it need refinancing at a specific moment of work, or can it just keep going? And time is your friend in real estate deals. Time is an asset. Running out of time forces you into doing something that you don't want to do. It's what kills most deals. Second, I care more about margin, I'd say, than optimization, meaning I'm less interested in deals that just look amazing on a spreadsheet. I think we've talked about this in Passive Real Estate Academy in our communities, that people can make it look however they want. I mean, I'm more interested in deals that have room to have a buffer to absorb what might happen in the market, whether rents don't go up like expected. They can be flat. Maybe there's higher expenses. Maybe there's slower growth. Is the model built for that? Third, I think about cash flow more right now in a very different way. I mean, again, it's not just income, which we talk about. And I think, again, cash flow, talk about it being the two most important words in personal finance. I absolutely believe that. Again, it's not just lifestyle money. It's a buffer. Like it buys you time when things don't go perfectly. It gives you options instead of forcing you into decisions that you don't want to make. I think about debt a little bit like a medication. You need the right drug, the right dose, the right patient, the right timing. It helps. If you have the wrong dose or the wrong timing, there could be a huge problem. Again, debt itself can be your friend or it can be your enemy. It's not evil in and of itself, as some other popular finance gurus might call it. I think leverage it's not bad by itself. Floating rate debt, it's not automatically bad, but it's not benign either. The real question is, how sensitive is this deal to things that no one controls, like interest rates, lending standards, time? And if there's one mental shift that I want you to walk away having watched this or listened to this, it's this. The goal in real estate isn't to win every cycle. It's to survive cycles well enough to benefit from them over time. It's a long-term game. And if you consistently invest throughout, just like it is in any type of other investing, it's like that in careers. It's true in how we design our lives. The key is, can you play the long game and are you set up to do that? When money is cheap, debt feels free. When conditions tighten, debt becomes a whole story like we're in right now. So the investor who wins long-term, they're the ones who respect that early. I hope they give you a little bit more insight into what's happening in the market today. We'll be talking a lot about that in the upcoming episodes so that you have a deeper understanding of how to make sense of the current market and then ultimately take advantage of what's to come. Thanks for being part of our community. Thanks for taking the time to listen to this. I appreciate you so much. Talk again soon.
Enjoy the show? Let me know by dropping a review in the podcast app you're listening to us in. And if you haven't already, make sure to hit subscribe. Join thousands of physicians who are also on this journey to creating their ideal lives through multiple streams of income. Learn more at our website, passiveincomemd.com. Thanks again for allowing me to be a part of your journey. See you next time.